By the end of this video, you're going to understand what confluences are, the kinds of confluences you can use, how multiple confluences together provide intel on where the market can be drawing towards, what happens at key areas of liquidity, and how to properly execute when price is within any confluence you're trading in the market. So the word confluence in trading means to stack multiple reasons or confirmations before taking a trade based on your bias. So what you're trying to do here is use intel and confirmation to get an optimized entry when you're trading in the market. So instead of relying on one simple aspect to take a trade, like support and resistance or indicators, you're using multiple pieces of intel to create an optimized entry and get a stronger bias. So when you actually use multiple pieces of intel or research before taking an entry, it's going to generally help you take more probable trades, especially in the long run. So if we have multiple confluences or pieces of information that we look for each and every time before we take a trade, we now have what's called a trading strategy. But in order to have a trading strategy, you need to have a proper understanding of the confluences that you can use when you're trading live. So I'm going to go ahead and give you guys some examples, so hopefully this helps you when you're in the market trying to take an entry. So there's multiple confluences that you can use before taking a trade, but the general three that I'm going to show you guys in this video is structural confluence, price action confluence, and liquidity and volume confluence. So the first one we're going to go over here is the structural confluence, and I put some examples like the change in state of delivery and the break of structure. So I'm going to go ahead and show you guys what these look like when you're live in the market. So a change in state of delivery generally occurs when we go from one trend to another. So I'm going to show you guys the specifics behind that and what you should properly look for. So the first example I'm going to show you guys here is from a bearish downtrend to a bullish uptrend. So we're going from down to up in this example. So if we're trying to spot a change in state of delivery from this downtrend, what we need to look at is its previous highs. So we have two options to pick from. We have this small swing high right here, and we have a higher high above here prior to price displacing to the downward side. So most downwards trends are going to make its final retracements before changing state of delivery and pushing to the upward side. And these final retracements here are what we're targeting to see a change in state of delivery occur. So for a CISD, we're generally marking out the body of the recent high or highs that we're looking for price to close above. And by the way, to see a change in state of delivery, price has to close above the body of the recent highs created in this downtrend example. So as we can see at this area, price closes above the two recent highs created from this downwards trend, showing that we're changing state of delivery from a bearish downtrend to a bullish uptrend. So we're showing a change in state of delivery here, which means we went from generally bearish to bullish. But I want to let you guys know right now, just because we go above a recent high and change state of delivery does not mean that we'll continue state of delivery unless we see it with our eyes. So for a break of structure, we need to understand that there's going to be a general trend, and then there's going to be small retracements that go against the trend that we're looking at. Just in case you guys don't understand, I marked out the areas where price goes against the general trend, which in this case, it's a bullish upwards trend. So when these retracements happen, a swing high is created, and that's what we need to look at for our break of structure. And by the way, if you don't know what a swing high is, it's a high in between two lows in the market. Just to show some examples, we have a swing high point right here in between two lows, and another swing high point right here in between two lows as well. So when price makes its retracement that goes against the general trend, there's going to be a swing high point left out, and that is the area that we're looking for a break of structure. So we're looking for price to close above the recent high created from this downwards move, which happens right here. And in the opposite direction, there's going to be swing lows in downwards trends, and that's what we're looking for price to close below to see our break of structure as well. So what I just showed you guys is structural confluence, and these things can generally show you where market is potentially liquidating towards or coming from. So the next type of confluences I want to go over with you guys is going to be price action confluence. And the examples I'm going to show you guys are going to be the rejection block, the order block, and the inverted fair value gap. So let's go ahead and get into it. So the first price action confluence we have in this section is going to be the rejection block. So I'm going to go ahead and show you guys what that is and how to properly use it. In order to understand what rejection is, you need to know what it looks like when you're trading in the market. A rejection is generally shown by the wicks, so we're looking at this example right here. So we were in a general downwards trend and price created these wicks at this area to show that we reject from this area and push to the upward side. So when we have an area of rejection like this, we need to wait for more confluence or intel that shows that we're pushing from this area once price goes within the rejection block. So we can see in this example, price goes to the downward side to test the rejection block, and then we go up and change state of delivery from a downwards trend to an upwards trend. So this shows that this area got respected and we pushed to the upward side, giving us more confluence to take a long entry. So the main objective with this rejection block is we want to see proof that price is moving from this area to show that we're changing momentum from a bearish downwards trend to a bullish upwards trend. Now we're going to move over to the order block and how to properly use it when we're trading in the market. So the definition of an order block is a zone or area of liquidity where orders were placed or filled prior to 1, a break of structure, or 2, a change in state of delivery from one trend to another. So what we're looking at is this highlighted area where price fills orders prior to pushing towards the downward side. So we can see at this highlighted area, price consolidates or moves within a range before pushing downwards, but these candlesticks here, they don't just pop up. Orders were placed by buyers and sellers, which creates this order block. So once we close below the recent swing low in this example, we get our change in state of delivery, and everything above this area is our area of accumulation of orders, also known as our order block. So what we're looking for with this order block is price to go inside of the area to fill more orders in the high area of liquidity, and also show proof that this area is getting respected by pushing to the downward side afterwards. So we can see right here, we push inside of the area, and then we show respect of the confluence, and then we go back inside of it one more time before displacing properly and moving to the downward side. So let's take a look. Price goes back inside of the area of confluence, and then we show proof that we're pushing away from this area, and that gives us intel towards our bias or entry point. And right here, price goes back inside of the confluence one more time before properly displacing and pushing to the downward side. So this is our order block here, and it's generally going to be stronger if we use it when we go from one trend to another. In this example I showed you, we went from a bullish uptrend to a bearish downtrend. The next price action confluence we're going to go over is going to be the inverted fair value gap. Inversion in a fair value gap happens when price closes above the confluence or disrespects it. So our highlighted area here is going to be the bearish fair value gap, which is going to be our area of observation to see what happens when price action reaches this confluence. And I say to use this as an area of observation because we have to see proof or intel that price is respecting this area instead of anticipating it and taking a trade with no confirmation. So price action inverts this fair value gap by closing above it right here. So what we're looking for is price to go inside of this area and show intel or confirmation that we're pushing up and breaking structure. So we get that right here, and price goes back into the area one more time before properly distributing to the upward side. So right here is the inverted fair value gap and how to properly use it. Just make sure that you're waiting for confirmation and intel before taking a trade in the market. So now that we've gone over structural confluences and price action confluences, the next thing that I'm going to show you guys is going to be liquidity and volume confluences. So for our liquidity and volume confluences, we have to understand what a sweep is and the difference between a liquidity grab and a run. And I'm about to show you guys this right now, so let's get into it. So in order to understand why sweeps occur, we need to have an understanding that each of these candlesticks we see in the market are generated by orders from banks, institutions, or retail traders. So when we have a downwards move or a rapid downwards move, sell positions and orders are being taken to the downward side. And when we have upwards momentum, that means long positions and orders are being taken, which is causing the market to push higher and higher. The main thing that you need to understand is that when price displaces like this and trades are being taken, these traders are going to have general stop losses, and they're going to be around the swing high or swing low point of these trends. So when we get momentum to the downward side, that means that sellers were taking positions and they wanted the market to go lower. And the stop loss of the sell position traders are generally going to be at the area prior to the displacement to the downward side. And it's the same thing for buyers that are taking long positions. Their stop loss is going to be generally around this area prior to price pushing upwards. So at this circle right here, price sweeps this area of liquidity, and now one of the two things that I'm going to show you guys can happen. So we're either going to get a grab, which is price filling stop loss orders and liquidating traders prior to reversing, or we're going to get what's called a stop run, which is price grabbing this area of liquidity and continuing to the upward side to fill more orders. So now that you understand this, when price goes above a key level of liquidity and fills orders, we need to wait for confirmation that price is either pushing down or reversing or doing a stop run and continuing higher. And once we see our confirmation, we can generally take a trade based on more confluences and intel in the market. So we just went over all three of the general confluence types I wanted to show you guys. And there's 3 key takeaways from this video that I think you guys should bring along with you as you're continuing your trading journey. The first key takeaway from this video is just because price hits liquidity doesn't mean it'll reverse. And we just went over this aspect. Price can do a run and continue higher just as much as it can do a reversal after grabbing and go lower. So what we need to see, not just with the liquidity sweep, but with all confluences, is respect. Clear signs that price is honoring the confluence. So if you have enough patience to wait at specific areas and gather intel, you're going to get that edge that allows you to take better trades in the market. And the last key takeaway here is going to be multiple confluences together can provide intel. So in order to build a trading strategy, you need multiple probable confluences together that can provide intel and work for you as well. So you need to make sure that you're doing backtesting to see if these confluences work for you. And you also need to have an extensive understanding of the confluences that you're using in the market. So backtesting is definitely going to help you with that. So definitely make sure to take these key takeaways and remember them because they can generally help you in the long run with your trading journey. So that's all I have for you guys with this video. By now you should understand what confluences are, how to properly use confluences, how to wait for respect with them, and the types you can get in the market. Please do me a favor and drop a like and subscribe. And if anyone has questions, leave a comment in the chat and I will provide an answer for you guys. Thank you guys so much for watching and make sure to take care of yourself.